Welcome, folks. This next presentation is going to be going over the introduction to infinite banking and the new accredited investor banking. All have access to the 3-hour eCourse within the Wealth Elevator platform. If not, please reach out to the team at thewealthelevator.com. We can get you access to that. What we didn't want to do is some real high esoteric view. We've been expanding upon the application of this, and we're going to be going a lot into that into the second half of today's presentation. We'll start off real high level here, folks who are new. What is infinite banking? It turns your short-term, mid-term liquidity. It allows you to generate a return there while you can take the money in and out through a loan and invest it in syndications, rental properties, stocks, bonds, mutual funds, whatever you want, while you're making money into two places. And we'll get into this a lot more in detail, but this is all part of the Wealth Elevator 1, 2, 3 trifecta, which is number one, investing in alternative investments. Number two, tax strategies, where you're getting a lot of the passive losses from alternative investments, such as real estate. And what we're talking about here today is the infinite banking portion of it, which is that third portion. And to me, when you combine these three strategies in tandem, it becomes a very potent package to getting to financial freedom. I've been aware of this strategy way back when in 2017. Back then, I didn't have kids and I traveled the country and met a lot of other accredited investors. And we would learn about these different types of strategies, such as what we're talking about today, where, back then I called it stuffing your whole life insurance and taking a loan from yourself. We've come a long ways. If you guys don't know me, my name is Kawaoka. I have a spouse, a kid, a dog, and a green Ford Raptor. And I grew up in Hawaii, went to college 2003 to 2007. And then for the next decade, at least, started to work for the man as an engineer. In parallel, I would buy a bunch of rental properties, which I started in 2009. And then in 2015, I stopped doing that as I learned credit investors started to trade in their little rental properties in for syndications and private placements. Together as a group, we've done over $2 billion of deals, over 65 projects, and I run the family office Ohana Mastermind. My partner here, Tyler Furukawa.
Hi, I also have a wife, 2 boys, and also a new dog. I grew up in Hilo, Hawaii, attended University of Washington in Seattle, way ahead of Lane, but I was there till 2001. I was commissioned in the Navy, so I served active duty for a while. Went to Jacksonville, Florida, Monterey for post-grad school, and then ended up back at the shipyard in Honolulu as a active duty Navy engineer. I eventually got out in 2009, did federal service engineering when I left that in 2021. As far as my investment background, I started investing in single-family homes back in 2002 and did what is known today as house hacking. And my goal was to acquire all of these single-family rentals. Eventually got overwhelmed, met Lane on the internet in 2018, and been on that alternative investing journey since. And along the way, I also, through all those groups, started listening and talking to people about this IBC or private vault or be your own bank. And I got really drawn into that and eventually became licensed in 2019, where I mainly was researching a lot of it for myself. And as I now have more free time and especially share my knowledge and experience with other investors, I'm wanting to do similar things.
Yeah, so 2019, I think you and I had the conversation. I was getting ready to do a bigger policy because you can make a policy and then you can do a bigger one, which is what a lot of our clients will do, including myself. And I was putting some serious money into this thing. And I knew enough to know that it's pretty technical. And what do you do? No different than like an apartment syndication when you're putting a lot of trust into your sponsors. But this life insurance stuff, I was like, hey, Tyler, you seem to actually like this stuff. Why don't you go learn it and make policy for me and all our friends, right? So that was where this all got started. And I guess when he quit his day job in 21, a lot of free time opened up. What you're going to see in this presentation today is the genesis of that. And we're going to be talking a lot about generalities in today's presentation. But at the end of the day, it's really like sitting down with the client, understanding what they're trying to do, and trying to tailor the custom product to what they're trying to do. And of course, always trying to keep it as cost effective for them as possible. Let's start off a little bit slow. How does the banking system work, and where does the saying come from, be your own bank?
Sure. Typical bank, basically how they generate their revenue is by utilizing deposits from people, from customers, and they're basically leveraging that, arbitraging it, having it work outside, and basically borrowing the customers or depositors' money, having their money work and grow their wealth that way. Banks, traditional banks, are able to leverage that through fractional reserves, unlike us, but we're basically utilizing a similar concept. However, I would say it's more simply, it's taking into account the buy, borrow, die strategy, as far as we are buying an asset, an appreciating asset that eventually grows, and we're accessing that liquidity via a loan. So we're borrowing it. Because we're borrowing it, we're able to leverage the tax treatment on that, and we're not basically paying income or capital gains tax. And then we're having that money work somewhere else. And at some point, we will die, and that wealth transfer will occur. It's not a step up basis, but the beneficiaries of your policy will get the step up, and a tax-free wealth transfer will occur there. It's a strategy that has been used for a while by corporations and also the ultra wealthy, and it's been in a bubble until the 80s when Nelson Nash popularized it and made it known what we know today. And essentially, eventually you're able to design something where it's a bucket that you can control. You have control over that bucket. It can be as large as small as you want, but essentially you now become your own bank, and you're no longer purely reliant on a bank. Of course, you still need the traditional banking system to move a lot of the money, but as far as making deposits, having it secure, requesting loans, all of that is within your control, hence kind of the popular term, becoming your own bank.
So we'll get some of the pre-notions out of the way. Dave Ramsey is pretty strong against like whole life insurance, and he sees it as a scam. We use whole life insurance as the backing of these policies, but it all matters how the policy is configured. Like Tyler said, back in the 80s, they started to configure the policies in a certain way that will optimize for the liquidity and the ability to take loans from yourself. And that was where the traditional whole life that Dave Ramsey is talking about deviated. Of course, we've taken that a next step further with the new accredited investor banking spinoff. I just wanted to put that out there because I think this is very different from what your run-of-the-mill salesman is selling. And I think Dave Ramsey is completely correct in his statement. Generally, whole life insurance, you probably should just get term life insurance. But again, we are financial hackers here using the specifically configured whole life insurance in a certain way to get the results that we want. You can see some of the quotes here, like the break even year 7, we can beat that with the ways we're configuring it. And he says certified financial planners, when they work with Northwest Mutual, they say they screw people every day there. Now, not to beat up on any one company, we'll talk a little bit about the different carriers that we'll use, but again, it's the devil's in the details and how the policies are particularly configured. The strategy is based off of insurance, whole life insurance specifically. This is some of the basics of insurance. There's whole life and then there's term life. Term life is your need is, say you passed away. Like Tyler's got a wife and kids. If he passes away, they'll probably be very sad and they'll probably need some money, right? And that's what term life insurance is for, to pay for the funeral and some future financial needs. And I think everybody needs a little bit of term life. But what we're talking about today is a little bit different. Yeah, sure, if you get a lot of whole life insurance, you can knock out that need for term life too. So again, that's where things get personal. For some people who have a little bit of term life insurance, perhaps you may be able to get rid of that monthly expense by getting set up with an infinite banking, accredited investor banking policy. The other portion here that we're not talking about today is IULs, and it always comes up into the discussion because it is a little bit more of an advanced insurance product. But the reason why we don't use IUL specifically is that they're a little bit more skewed towards getting higher returns, but the trade-off is a lot less stability there. I know, Tyler, you wanted to add anything on that? I know clients always ask you, how does it look if you configure it with an IEO, which I mean, you always can, but
Yeah, so for me, my preference, again, we're establishing a secure financial foundation with the use of whole life or the use of this strategy. And for me personally, I prefer that to be a stable product. Because the way we structure it, you have liquidity and you have access to your funds within the policy. For those seeking higher returns and alternate investing, you can still do that, but I would do that outside of the policy. Secondly, IULs are the chassis or the actual insurance product is a term life. So there's a lot of unknowns there. And because we're using the strategy for long-term thinking, and long-term could be generational wealth beyond your own life, the unknowns of term insurance and the cost there is a risk that I prefer not to take. And then going back about Dave Ramsey and the whole life versus term and just the use of whole life as it being expensive. Yeah, he is correct. But the use in their purposes is for the death benefit, where IBC, the focus is on the cash value of the whole life and not necessarily a death benefit. The death benefit is there. It is something that you'll gain, but the focus is truly on the cash value component of it. Again, the strategy really is buying an asset. The asset of choice for this strategy is whole life. You could use a house, your stock portfolio similarly, but the reason why we like whole life for the bulk of the strategy is because, like the name says, it's whole life. It's level set premiums. It's a contract. Those can't change based on your age or your health over time. So you lock that in when you get approved. There is guaranteed portion and guaranteed growth of the policy itself. That's one of the strong features of whole life. If you pay the premiums and it's there, you are guaranteed a cash value component, a death benefit there. It won't lapse per se. And you can, because of that stability, then it allows you to maybe be a little bit more aggressive in other areas of your life, knowing that you have this set financial foundation. Again, in the name whole life, so it's covered over your whole life versus like term, where they're maybe purchasing term for just 10 or 20 years out. This coverage will last your whole lifespan. The product that we use and the company we use is with a mutual insurance company, participating mutual insurance company, which pays dividends. So as a policyholder, you are basically part owner of that company, and the company shares the profits of that company to you as a policyholder via dividends. Again, dividends are not guaranteed, similar to stock companies. Paying dividends, they're not guaranteed. However, with majority of the companies we use, they've been stably paying over the past 160, 65 plus years. There's some stability in there.
And that was like that came up this past year, right? Like we saw a lot of banking crisis, SCB Bank, First Republic, and I think everybody should understand you don't want to put more than the federally insured $250,000 per bank account. I think everybody understands that, but generally speaking, the banks are a lot less stable than your own policy here when you're taking an insurance contract from these top tier, top rank insurance companies such as this. Like Tyler said, these policies have been paying out for quite some time. Some is even as early as like the Civil War era.
Yeah, and unlike banks, they aren't able to do fractional reserves. So they need to have the liquidity to pay the death benefits that they have on the book. Stability wise, for insurance companies are a lot more stable than the everyday bank. Designed correctly and utilized correctly, these policies can be generating tax-free wealth. You're accessing the funds tax-free. There is a fee. You are borrowing against your money. So there are fees with that, but those fees are way less than any capital gains or income tax levels. And then upon your death, the accumulation of wealth in your policy will transfer tax-free to your beneficiaries. And then last but not least, we're utilizing whole life. There is a death benefit component to it. That's not why we're using it, but that benefit is there, and that helps with estate planning, legacy planning. It is a portion that I mean, people later on, as they age, that benefit becomes a lot more valuable to them, even though that initially wasn't the true focus when we're designing it. And there are other features because it is insurance. There's other riders you could attach to it that could make it a utility belt as far as a product. But yeah, there's other side benefits to this.
And I'll go over like why I personally do this for myself. And I use this strategy pretty heavily, probably over 7 figures myself into this stuff. People like who are high net worth or in high liability professions, like as doctors, use this to hide your assets away from creditors and litigators. With it being life insurance, think of it very similar to people who have 401ks or retirement accounts, how they're sheltered from litigators. Of course, every state is a little bit different, and we're not CPAs or attorneys here. Of course, if you guys need a referral, let us know. But everything that we're not getting any tax or legal advice here, of course, is basically what I'm saying. But this isn't stuff that we don't do ourselves or is not very common within our community. So what a lot of people are doing is they're comboing this with their irrevocable trusts and their other LLCs, asset protection strategies. And I like it because as opposed to throwing it into my irrevocable trust and it's gone, I don't have control over it. By having it in my infinite banking policy, I have a lot of control over it while still getting that asset protection there. The big one I think most people will subscribe to as that immediate benefit is the tax-free component to it being insurance. And that's the loophole here, guys, right? At one time, people were using the strategy pretty egregiously where they would just throw a heck of a lot of money into here and it would just grow tax-free. The government caught on to that and they imposed what we're going to be talking about later as MEC limits. So they brought it back to a point to keep it under control somewhat. But that's where a sophisticated investor and working with the right life insurance broker can keep you within the constraints there to optimize the strategy, because that's why you're doing this, right? Is that tax advantage here. And if you're looking for another way to think about it, think of this as like a HELOC that you're getting on your home. People, they take a home equity line of credit from the equity in their house and they go invest it. They go use it to pay for their kids' college. Very rarely do people use it to renovate their house, which is what it was marketed as originally. That's the whole game of being an investor, is to take your lazy debt equity and to arbitrage it somewhere else. And now you're able to put money into your life insurance policy, have it grow, and then take a loan from it, and then put it elsewhere and grow your money in two places. And this is where the double dipping effect is, with the tax-free component, with the asset protection component. And this is why back in 2016 and 17, when I started to see this, it started to make a lot of sense. It was a little confused, and maybe some of you guys are now. But I think that's where, for me, a lot of these strategies came alive when a lot of high net worth people were doing this. And I would urge you you need to get around other accredited investors. And that's why we do events from time to time. We're going to be doing Las Vegas here in January for our annual retreat. I think the hard thing with people being so disconnected these days, and a lot of our investors are very busy with their families. When you're sitting at a computer observing a webinar, you may not have the people in your close circle right now who are doing these types of strategies, investing in alternative investments, buying rental properties, and it could just be under your nose. And it's just a matter of getting around the right people. I'm here to talk about this stuff. Tyler's here to share his experiences. If you guys want to book a call with him, to me, it's the community aspect. Seeing how people are using these strategies and more holistic strategy, I think, is what really brings a lot of this stuff alive.
If you look at any large bank on their portfolio, whole life insurance is a pretty big portion of it. It is called a little bit different. It's BOLI, or bank-owned life insurance, but they hold a lot of life insurance. They understand life insurance. That is one of the tipping points that made me decide to also get involved with this strategy, because you're able to take your life insurance policy to a bank. Because they understand a whole life structure, they're willing to lend, provide you a line of credit, usually 95, even 100% of your cash value, to a whole life insurance policy. Because they understand the stability of it, they utilize it themselves. Other large corporations use it as key man insurance or for buy-sell agreements for partnerships. And it's a well-utilized strategy to large corporations and maybe the savvy. And it can be available to everyone.
Yeah, there's something I've learned is success leaves clues. And as Tyler mentioned, the big banks will put this on their balance sheet, but also the big companies like Walmart, Disney will take out the same type of policies out on their key employees to implement the same strategy. I think a lot of people, they get this stuff mixed up again with normal whole life insurance. Normal whole life insurance is those kind of the scams again, where your acquaintance from college or high school gives you a call, wants to go take you to lunch and sell you a term life policy or one of these whole life policies. Or nowadays, you get a lot of these people selling the IULs, which are very high fee product. But again, configured the right way to this infinite banking accredited investor type of need. And this is where we get into a lot of poor design and the improper usage of the same whole life insurance product.
We'll get more into what we consider poor designs, but essentially, if people are focused, because we're using whole life, the traditional use of whole life insurance, that purpose is for the death benefit. So think about it like any other insurance, you often want to pay the least amount of premiums or fees for the largest benefit. So whether that's your home insurance, your auto insurance, life insurance in that traditional way, you're looking for the lowest premiums for the highest death benefit. IBC inverts that, and you technically want to dump in as much premiums, whether that's base premium or paid up additions, PUAs, into a policy, and you want the least amount of death benefit because death benefit is associated to expense and costs. Because we're designing it for cash value, we're inverting that. And then similarly, improper use, oftentimes whole life use a traditional ways to protect your human life value for the death benefit purposes, or as a super safe savings account that'll grow at 2% or so. The traditional way would be dumping a lot of money into it and just leaving it there for a rainy day, whereas IBC, the power is really accessing that cash value so that you can have your money working in two places, but you're also, the funds, when it leaves your policy, it's not being withdrawn, so it continues to compound and grow within the policy.
Yeah. And this is why back in 2017, I thought it'd be nice to have a guy like Tyler build my policy for me, because I could give him a hard time and have him charge me less commissions. But it's essentially, this is the name of the game, right? For these brokers, what they want you to do is do the longest policy, like a 7-year, 10-year type of policy. And they want you to do the biggest death benefit, because that life insurance portion is where their commissions come out of it. Tyler just mentioned we've invert that for our purposes, because it truly does make a better infinite banking, accredited investor banking policy to invest out of. And then I'm more on the investor strategy side, and that's the improper usage here. Some people use these type of strategies to pay off debt. And if you've ever seen that sweep strategy where you use your HELOC from your mortgage to pay off your mortgage, great way to pay off debt, but not really aligned with financial freedom. And some people are misaligned and they don't really see the long-term vision on that. What you want to be doing, especially if your net worth is under $4 to $5 million net worth, is to take that money and to put it into more higher yielding investments and to grow your equity over time. So that's where we've coined the term accredited investor banking, and kind of configure these policies in such a way where you're now able to go on the offense, take the loan from your life insurance policy, and then go and invest it in investments. And then at a future date, once you've hit your critical mass, or I call end game type of numbers, which ranges for all kinds of people, anywhere from a few $1 million net worth to $6-7 million net worth, to finally come back and pay down your policies from there and store up your cash value. And at that point, use it as a storage vehicle. But some people tend to use this stuff as a storage vehicle first, which to me, again, especially if you're under $2 or $3 million net worth, doesn't make too much sense. But again, we're not going to go down the list of participants here and what is everybody's net worth, liquidity, etc. really gets into the more personal refinement of this. And especially because we're using this to go and invest elsewhere, we really want to have that stable foundation, which means not to use an IUL, which is a little bit unstable in terms of your base policy.
This reiterates the importance of policy design. We're mainly focused on maximum cash value, and as investors, the early cash value of it so that we can access and have it growing. But then we also need to keep it looking like insurance. So as Lane mentioned, pre-1980, IRS was not involved. People were able to basically dump in, say, $1 million and have $1 worth of death benefit or insurance. In the 80s, IRS got involved and created limits. You might hear it as the 7-pay test or the modified endowment contract limit or MEC limit. But essentially, it's limiting how much, a ratio basically of how much you can stuff in the policy and how much insurance you need based on how much money you're putting in the policy for it to still look like insurance and still receive its favorable tax treatments.
And I'll give a little story more on the tax side. If people are familiar with real estate professional status on your taxes, which has nothing to do with being a real estate agent or any of that type of stuff, but it used to be a decade or two ago that a lot of the doctors would just have their spouse, they would just buy one little dinky rental property, and then they would check the box on their real estate professional status. And then now they would be able to use all their passive losses to offset their ordinary income. So they would go into these types of tax pile funds, investing in equipment like ATMs, and pretty much bring their adjusted gross income from like $1 million, $500,000 down to zero if they wanted to, right? And then the IRS kind of put a clamps on the rep status and started to put some restrictions, such as the 750-hour rule. Still, some of our clients are able to work with their CPAs, and we've found the good ones that are able to be creative on this. But I just want to bring that up as an example. Again, like at one time, these policies where you could just stuff all the money in here, and yeah, in my opinion, it's abusing what it was, but there were no tax laws written it to control it. Since then, there are these controls over it. And it's important to stay in those constraints to do this completely IRS legal. But I say that because things change in the future. And typically when you're grandfathered into something like this, you're glad you did it. And I think a lot of people say, this sounds great. I can fund a policy 5 years from now. I just don't know if it's going to be around. And I think this is where the game is always changing somewhat. And I guess the thing is, the best time to get in was yesterday. When I first started to get into this business, you could do 120, 140% return on your money in 5 years on some of these apartment deals. And then it changed, right? The game always changes. And when it changes, it doesn't seem to get any easier from what I've seen.
Yeah, and similarly, we're often working with limits, which can change. And the two main limits, I'll go on the right side first. That IRS limit doesn't change as often. We did have a new law change in 2022 that kind of shook some things up, but that's the IRS MEC limit, which is basically based off of your age, gender, and a health rating. So that kind of gives you that ratio of how much insurance or death benefit you need per every dollar that you put into your policy. That we cannot exceed or cannot manipulate as much. Once it becomes a modified endowment contract, that is something we do not want your policy to happen to if you're intending to access the funds, because even policy loans at that point become taxable. So we want to stay below that limit. On the left side, the company limit, so that's where that changes over time. Companies can put limits on basically how much PUAs or paid up additions, which is also known as basically the cash dump or cash value of the policy. So there's limits on how much per the base premium and PUAs, how much one can put in. That changes often. That we can manipulate, and we've been pretty aggressively pushing the limits on that, which then benefits the cash value, especially the early cash value for our clients. But those mainly are the two limits we're working on when we're designing the policy.
If you've heard the term infinite banking before, it's a ubiquitous term for the most part. I would probably ask if you've done it in the past, I would ask the question, what is the split between the premium split here? So here on the left side is when most people say, yeah, I got an IBC policy, I'm good. This is typically when we break it down. And for some of you guys who do have life insurance policies, whole life policies, and it is configured in this type of flavor, we usually look under the hood and we see a premium split of a 50-50, meaning 50% of it is going to paid up additions, which is what you want to maximize. And the other 50% is going to the base premium. And remember, the base premium is what that insurance agent is getting paid out of. So you can see there's a conflict of interest here, right? They want to try and bolster that up so they can have a nice bonus payday there from the client's dollar. What we're trying to do here is invert that and go to a 10-90 split. Now, what this does is it bolsters up those paid additions and saves you guys a lot of the commissions here. And what this also does, it makes the minimums that you have to put in every single year much, much less. The difference between a 50 and a 10 is 5 times less than you have to put in every single year based on the old traditional IBC policy. This is a good diagram, I would say. So every year I'll throw in, every year I have to put in, I forget what is my policy, Tyler, you did it for me, but I think I have to put in like 50 grand is like my premium, but I can stuff in 300 grand of paid up additions every year in addition to that. So every year I'm paying the small commission base on that premium, the smaller portion, but my paid up additions aren't really touched.
Yeah, and to elaborate on this, when we say old IBC, I think that was if you refer to Nelson Nash or the earlier founders of this strategy, they're appealing more to the masses. I think our strategy is very tuned to investors, or it's skewed to investors, where we intend to access the cash value early on and grow it outside of the policy as well. You may hear the term, there's no discount in insurance, or you're not going to find a deal in insurance, because a properly structured whole life insurance product by itself, amongst all the different companies, it will perform the same way how you design it. So if you're doing a 50-50 split, you're going to maybe end up with better long-term growth. And when we're talking long-term, you're talking like 50, 60 years down the line growth of the insurance product itself, but you're not going to have much early cash value, or your early cash value would be hit. Our designs, when we go to the 10-90 split, we're very focused on, one, you're boosting up the flexibility. So as Lane mentioned, the annual required minimum amount is based off of the base premium. So it's a lot smaller, so it allows larger flexibility as far as annual premiums. And then secondly, because of the larger paid up additions portion, that's the least amount of fees on those portions. So that's the highest cash value, and you want to maximize. That allows you to have the early cash value to access to grow outside the policy. And as investors, we're able to basically now have an asset outside growing along with the policy. So when you're looking 50 or 60 years down the line, yes, our insurance product returns may be a little bit smaller, but our overall net worth is larger because we're able to access and put that money to work outside of the policy. So it just, if you hear, it's not saying that a 50-50 split is wrong. It just, for our purposes, isn't ideal.
Yeah, I think you elegantly put that, Tyler. Sometimes I got to catch myself and saying one thing is wrong or right, but it depends on who you are, right? If you're an investor who, you have 10, 20 grand lying around and puts it into the next investment, then you're probably better off to be on this right side, right? That's our community, right? We are investors. But if you're somebody who just wants to have your money sit and just make 5% over it because you just have so much, or you're just uber conservative, you just don't know what to do with it, then that 50-50 premium split is the way to go with that. Some of our FOOM members opt to even go with a 70-30 split, which is midway between these two. And there's different reasons why they would do that. And I would say that would really need to get teased out through, you guys get to know each other, you hop on a call with Tyler and really talk long-term holistically what's your plans. But I think that's the whole purpose of like our community, this Wealth Elevator project, which is we are investors for investors, whereas the life insurance guys are typically, they're just there to sell you insurance. And they typically work with the masses who are looking more for just very conservative types of products that they're not going to doing these types of more advanced strategies that we're doing, such as taking the cash value and investing it elsewhere in a rental property or a private equity deal.
Yeah. And going back to some of the accompanying limits, that base premium to paid up additions ratio, that's where some of the companies differ. Some people allow maximum 9-1. So 9 times paid up additions to base premium. Some allow 10, some allow 20 in certain situations, some even allow 50 in some certain situations. So that's what we're trying to maximize as far as to reach people's ideal situation or goals.
And also not shown here is the new accredited investor banking. Didn't really know how to make a visual on that, but we can talk about that in kind of the end of the presentation if you guys want to stick around for that. So how do PUAs maximize cash value?
Because a lot of us are mainly real estate investors, this was a good analogy in the sense that base premiums could be associated with your mortgage. So when you make that mortgage payment, there is a small principal pay down with that. And that is helping to build up your equity very slowly, but it is consistent and it's there. Paid up additions could be looked at as doing a value add project to your house. You're putting your money into your house for a renovation, and that boosts up the value of your home, and then therefore your equity on your house is increased a lot more quickly. So for example, say you pay $5,000 mortgage, maybe $1,000 of that is the principal pay down. Whereas you do a $5,000 renovation, you may boost up the value 10,000 or so. And that's your added cash value in this case. So paid up additions, we want to maximize very little fees, almost 1-for-1 as far as boost up in cash value, whereas base premium, especially early on, lots of fees, does contribute to some of the cash value and the growth of the policy, but it's a lot of drag, especially in the beginning of your policy.
So now that we've created this symbolic construct here, we had a good question that rolled in, which was, what if I have extra cash sitting on the sideline? Do you advise dumping it into the paid up additions here? And this is the strategy in a nutshell. Like the paid up additions would be like doing a renovation on this metaphorical house, which is your policy, right? So it would increase the cash value of your policy. So your other option would be to take that money, and this is what most people would be doing, right? Who doesn't have an infinite banking, accredited investor banking policy, is if they had 50 grand, they would just plop it into a syndication deal or go buy a rental property or two. What we're saying here, the strategy is to take that 50 grand, put it into your house here and as paid up additions, and have the policy get bigger, and then take a loan from the policy, very similar to a HELOC, and then go invest in that real estate deal or buy that stock or whatever. So it's an additive process, part of this. But when you do it that way, this house that you're seeing right here, your life insurance policy, is growing in value, and you're able to also take it money as a loan from this house and put it elsewhere. So you're growing two pieces at the same. Now, there's obviously going to be some fees by doing this, that there is that break-even point. We'll get a little bit more into that, typically around less than year 5. But now you're seeing this all, the big picture of putting this all together, right? It's the iterative process of dumping money into here, taking it out as a loan, put it into where you were going to put anyway. Now, it's not required, right? I never invested like this when I first started, but once you get the hang of this, man, you're making money in kind of two places at once with the additional litigation protection, and then the tax savings there help too. But in a nutshell, if you're having a hard time kind of understanding this, think of your life insurance policy as your house and it being like a HELOC, but better, because unlike a HELOC, a bank can pull your HELOC anytime they want it. And it's always going to be during the tough times. And it's not asset protected where this is. And the hard thing about people with HELOCs is the banks who give you people the HELOCs, they typically play a lot of games with sandbagging you on the appraisals for your property and giving a much lower loan to value than what they previously promised.
Actually, Lane, I should the paid up additions actually the analogy would be better if it's you're adding on to your house, because then perpetually that'll add value versus just paying down your mortgage. So maybe that's the better analogy. When paid up additions is like adding a little addition to your house. So it's a bigger house now, and the value now grows on the bigger house perpetually for the life of the house. Similarly, like when you do paid up additions to your policy, it increases the whole life value of your policy, and that just helps starts the non-interrupted compounding for the rest of the life of your policy.
Taking a loan from the policy.
Yeah, so similar to a HELOC, but your money, when you take a loan, and we're talking specifically maybe a policy loan in this case, the money really doesn't leave your policy. You're not withdrawing. Your policy is still there whole. What the insurance company really is doing is collateralizing your death benefit. Again, there's a limit on how much you can take out based on your cash value, which is related to your death benefit. But the reason why you can take that loan out without any approval, you just have to have that cash value available, is because they know at some point, even if you don't pay back that loan, that they have this death benefit. And if you don't pay back the loan and you pass away, they'll basically just subtract that outstanding loan amount from your death benefit and then give your beneficiaries the remaining amount. Your policy still is whole and it still continues to earn. The earning rate may be impacted based on the type of insurance company you use or the type of product you use. However, it's still there earning. Unlike your bank account, once that money leaves your bank account, you lost that earning power of that dollar, and it's only in the asset that you put in. The bank stops earning. Very similar to a HELOC, staying on the real estate relation, is a HELOC, whether you have that HELOC out or a mortgage out on your property, the property as a whole continues to earn, continues to grow and appreciate whatever rate it was going to appreciate at, whether it was free and clear, you have a mortgage, or you have a mortgage and a HELOC.
So a little bit more like logistically speaking, a deal comes up and you need to pull some liquidity to go and invest in it. So simply all you do is you call up your agent, or you go on the computer portal and you get a loan from yourself. I think some of you guys who have HELOCs, a lot of the process is automated. So very similar process. Here's actually a screenshot of, this is how I keep track of my stuff personally. Like I have a few policies with Penn, Guardian, Amerita. Of course, those are some of the top tier carriers, but of course you have to configure it the right way, right? I always try and keep track of my percent that I'm paying, my loans out, and then here's 23 would be like $53,000 of premiums, and my paid up additions would be like 200 grand. So I try and keep track of that stuff, and that's my simple way of keeping track of this. And a lot of this is in the Accredited Investor Banking, Infinite Banking eCourse that we have broken up into. It's a user's manual for this type of stuff that you guys have all access to. I call them, I submit the form, I get the money and invest in a real estate deal, or I can pull the money for anything you want, basically, just like HELOC.
Yeah, and a little bit more in the logistics. Most people just go online. Most of the companies we use have an online portal. Very simple. You go on, a few clicks, electronically sign the loan or the loan request, and 1 or 2 business days later, the funds are electronically deposited into your bank of choice. Relatively seamless process, and it's not going through a lot of paperwork, getting credit checks or approvals. You have the loan dollar amount available, request it, and it shows up electronically in your bank account.
Not like a day or two. It might be like a few business days or a week, but it's pretty quick. Just got to plan ahead a little bit. So if you're one of those guys who likes to wait to the end to wire your funds in, maybe you got to plan a few days ahead. But for the most part, it is pretty quick liquidity to access your liquidity, and in a place that's a lot more secure than any bank account. Unless you're with JP Morgan, who's probably the only bank who's going to get bailed out if anything really bad should happen. That's just my opinion, though.
Basically, you have your policy, and you have 100,000 cash value sitting there. You can request a loan, 60,000. The loan itself is simple interest calculated daily, And as far as repayment requirements, that is optional. We do like to emphasize that in order to keep it simple interest, what happens is on your policy anniversary date, you want to make sure that you're prepaying the interest for the next policy anniversary or for the next year. So you want to make sure you pay that so that it keeps it simple. If not, it'll basically compound and roll the outstanding loan interest into your loan principal balance. And then the loan interest for the next year will be recalculated at that higher amount. To prevent that compounding from happening, we emphasize paying the loan interest annually. But just because you took that loan out, that $100,000 of cash value in your policy is still earning. Again, it can vary. People may hear a direct recognition or a non-direct recognition. So for direct recognition companies, they'll recognize you have that loan out. Usually what they'll do is they'll match the gross earning rate with the loan interest amount. So it's not really a wash, and we'll get in more details when we do a call to look at the actual numbers. But that whole amount is still earning something. So in this case, we'll be conservative and estimate net 4%. In that case, that's earning $4,000. Your loan interest that varies based on what company you use. We see between 5 and 6% normally. A lot of the companies we use, the main company we use, it's advertised as 5%. What you truly feel is 4.76% because you're paying that up front. But for this example, we just use 5%. So you have that loan interest of $3,000. And then you're putting that loan in an investment. And most of us are doing cash flowing investments. I personally like to go into that cash flow can cover the debt servicing so that out of pocket, I'm not having to pay that loan interest. But essentially now you have your policy growing and then this appreciated asset growing with that same dollar that you've initially started with.
And if you're more of an aggressive investor because you have a lot of liquidity lying around and maybe you don't care about cash flow, maybe you just want to take an extra cash value and just stick it on the side or just keep it in your policy and invest in investments that give you way more than 12, 15% a year, but you got to wait till the end, right? And this is again where you run into so many permutations and commutations of this, and this is where you need to really interact with other more advanced investors to piece this all together, because we're just talking about one investment, one $60,000 placement into a deal where you may have dozens and dozens of these types of things going on. But it just shows, it illustrates this on like a one taking the money out level. The other side of this is more personal finance. For me personally, I like to have about 20 grand at least in my checking account. I don't really see the need for anybody to have more than that. Where do you keep the rest? Well, you keep it in your infinite banking policy. This is the alignment that most people have these types of policies have, right? The overflow stays in the infinite banking policy where it's off the table of litigators. And when maybe Christmas is coming up and you got to pay a lot of bills, maybe you buy a car cash. I don't know why you would do that, but then you drain your checking accounts and you replenish your short-term liquidity stores with your cash value. Right? That's another way of playing this. But for a lot of people who aren't utilizing this strategy, and they should, maybe walking around with few $100,000 of liquidity in a money market account or their online checking account or their savings account, really need to start to look to this strategy to use this as that alternative mode to keep the cash value in this types of policy, but also invest it too, taking a loan from it and investing it. But again, the big picture here and the one of the big reasons why this strategy makes a lot of sense once you understand it is you're making money in two places here. The policy is growing, which is depicted here on the left side, and your investments are growing too on this right side. And so we're going to get a little bit into like different use cases for these policies. And again, this is the hard thing where everybody is listening here on the screen and you don't really get around other more experienced investors. So Tyler put this together as one in the wild use case of somebody kind of building up their policies and investing it so you can see this as a working model, and then hopefully it inspires other ideas from there.
Yeah, and I'll say I derive this basically for myself, actually. It's utilizing basically $100,000 target amount design and myself funding it over a few years. So in this case, it would be the first 4 years out of pocket funding. And then from year five, as those initial deals start either refining or exiting, using those returns then to fund the policy. But if you look at year one, the biggest expense or the hit we call is that in year one, you lose a bunch of liquidity because the fees for the insurance product itself, is a lot of it is front loaded. So if you look at year one, where we have $100,000 policy design, the actual MEC limit is $150,000 in this specific design. So Guardian, which is the company we use heavily, would allow us to basically fund up to the MEC limit, so 150,000 in this case. I'm just showing funding 125,000 in year one. You would have about $100,000 cash value. So you lose, say in this case, 25,000 liquidity. Again, we're able to design much better designs, but just for this case, we were being very conservative. So you have $100,000 available cash value from the 125,000 initial deposit, and then you take that out in a loan, and now you fund two $50,000 deals. In year two, now you basically fund your policy 100,000. You'd get about only 98,000 of that in cash value available. So you still need out of pocket $2,000 to subsidize it. Take out a $98,000 loan, which are 2,000. Now fund two additional deals. So that's a total of 225,000 and 227,000 really out of pocket. And now you have 200,000 outside working for you. Year three, very similarly, you dump in another 100,000, but in this case now it's a little bit more efficient. So you actually have $101,000 in cash value. So you're able to not have to subsidize out of pocket. You can take $100,000 loan, fund your next two deals, and in year four, similarly, another 100,000, and take out $100,000 loan, fund those additional two deals. Again, these are all very theoretical numbers. So typically in year five, those deals, and we're talking syndications in this model, would have stabilized, potentially be exiting, and now you can use those proceeds to no longer have to pay out of pocket that 100,000. You can now take that 100,000 and fund your $100,000 policy, and so you no longer have to pull that out of pocket, and then you can take that other 100,000 and then fund additional two deals, and you just continue that way. At the end of year eight, you basically have this total cash value. You do have some outstanding loans, but then you also have funded numerous deals that then can, as they exit, help continue to fund this machine. So that's one way of just jump-starting your investment journey. Initially needing capital out of pocket to start this machine, but eventually then having it fund itself, and the growth of the policy also helping to capture the debt servicing from the loans.
Yeah, another tool that I would say is a little bit more conservative way of investing is we've got the tax pile fund with the ATM machines where you get the 25% pref on that. Not saying that you do it all with that. That could help you pay your debt service on it initially or kick you off. The upside isn't going to be as high, but that's just another way of playing it. And this is where there's a million ways you can create this pipeline for yourself. But when you add in, it is another step, it is another, layer of complexity. But I think a lot of people that are on the call, you guys are very smart people to add in this kind of intermediate, put your money here before sending it out. It just builds upon each other, making money in two places again. So here's a more of a high level through this. Step one, you contribute 100 grand, and I'll get a little bit later on in the presentation what I think is a good starting point for most people. You start one of these policies, you obviously got to work with a licensed insurance professional and customize it to where you are. And if you guys see the link for Tyler to book a strategy call, it's in the eCourse, or we'll send it out to everybody here, or just send team@thewealthelevator.com an email. We can get you guys connected. Step 2 would be establishing this banking from yourself loop. And you take a loan from yourself. Say you take $85,000 against your policy. Step 3, you leverage a cash value, borrowing from your own policy to get capital working into your next deal. That's what Tyler was showing here on this page. Step 4, you put it into that income generating asset. Or if you're a more of an experienced investor and you don't really care about cash flow, you can just float it. Then you'll probably be rewarded with greater equity growth at the end anyway, as a lot of times cash flowing deals do not yield as much as non-cash flowing yielding deals that are more equity growth, such as developments. Step 5 here, have your generating assets pay the loans. And step 6, your policy and your cash value grows over time. Again, that's the double dipping effect. Now, we just threw a cone in the middle of the road here. Unexpected expenses, loss of job, college savings. That's also the alternative purpose of having this cash value in your account, to be able to take a loan from it and to get it anytime. And then step 7, enjoy the benefits of the policy as well as the death payout. Now we're getting a little morbid here, as most of us in our little group will jokingly say we're worth more to our spouses dead than alive. But that's where death payout does kick in if the unfortunate event does happen. But then the step 8, and I think Tyler's really good with this type of stuff, is getting his family involved and using this as the package, the vehicle to teach the kids, the next generation, about using money the right way, the good usage of debt and understanding risks and investing, which go hand in hand. And this is where, if you were to pass away, it becomes a great mechanism to just hand it off. Whereas I think most people pass off just cold hard cash to the kids or properties, and then what happens? The properties are liquidated and the cash is just blown, just completely blown. Whereas when you have it within these type of policies, and then more importantly, you're able to show them how you're using the policies in a particular format such as this, then now you're showing them really the mindset that they need to have, which has been a passion of mine to educate everybody. But let's bring this a little bit back to earth here. We have a little bit of a policy illustration for you guys here. I'm going to switch screens really quickly for you guys.
This is all for a 40-year-old male, preferred plus health rating. So that's a good health rating. This is with Guardian. They're all an annual target amount of $50,000 each, with a funding duration of 10 years for number 1 and then 16 years for number 2. So you can think about it like a bucket size of 500,000 for the 10-year funding, which is basically 50,000 times 10. And then for number 2, it's a 16-year funding duration, so 800,000. That's pretty much the maximum duration as far as the efficiency design for these. So that's one of the downfalls maybe to these designs, is that there's a limited time you can fund it. Looking at how these perform, I created this spreadsheet so that you can compare the numbers side by side. And for the year 1, I have this percentage up here. That's year 1 liquidity. That's just so that you can know how early efficient it is, because a lot of us are just wanting to dump in money and then accessing it right away. So the higher percentage obviously is better for most of us. You are possibly giving up some of the projected long-term growth. Again, I emphasize projected because that's not necessarily guaranteed. But by having the early cash value is one of our main focuses. The yellows here are where the policy would break even. So that's the cash value equal to or greater than the outlet. And then I think on the illustrations themselves, 25 pages long. One area to look at is page 13. So I took these numbers. It's from this middle column. This is supplemental numeric report. So starting on page 13 of the illustration, but it has 3 columns: guaranteed, non-guaranteed current, non-guaranteed intermediate. So these numbers are based off the non-guaranteed current. So this is making the assumption that you'll receive a dividend of 5.75%, which is the current dividend. And guaranteed, so Guardian has the whole life. For this specific product, it's the guaranteed gross interest rate of 3%. So this is showing This is the contractually worst case with the largest company expenses and receiving zero dividends, essentially. This is the projected numbers. And again, these are guaranteed. So one of the whole life's, and especially Guardian strength, is this guaranteed side of the policy. And then the non-guaranteed intermediate is the halfway point between the current dividend, which is 5.75 and 3%. It's the midway point with that, which would be 4.625 or somewhere around there. But this is the intermediate, so a more conservative dividend estimation. Again, granted, we are in a low dividend environment, so it's most likely that dividends will go up in the future or at least remain the same. So even though this is not guaranteed, it's probably pretty conservative. So looking at number one is the 50,000 10-year. I put the MEC limit also up here. So the actual MEC limit is 77,376. Number one is just kind of showing if you fund it 50,000 a year for 10 years straight, just a straight funding, total 500,000. Do keep in mind though that there is flexibility on, you don't have to dump in 50,000 all at once. It's really the sum of this base premium, so $45.46 plus this $542, which makes it $5,089 is what's due annually. And then $44,911 is unscheduled paid up addition. So that's flexible, optional. Again, you don't start earning until that lands on your policy, but it is flexible. Big bonus with Guardian is the flexibility on the PUAs. This is showing the straight funding 50,000. 1A shows what I would call front loading, because Guardian allows you to shove in up to your MEC limit in year one. So this really just, and I'll highlight it because it's red, but it basically shows you dumping in up to the MEC limit year one. So instead of 50,000, boosting it up to 77,376. What that does when compared to the previous one, liquidity of 87.95 year one, it boosts up to 91.33%, purely because this PUA portion is what that additional portion is tied to, and it has the least amount of fees, so it helps boost up that cash value early on. Then still breaking even at year 4 or so. And then 1B, I just wanted to show some of the flexibility that even though it's a 10-year funding duration, you don't have to fund it for all of those 10 years. What happens if you just front loaded it and then just put in a total for 5 years? So it's 277,000. What happens? The first 5 years will look the same exactly. And then the last 2 years, so year 6 and 7, there's still the premiums that are due. So that will come out of the cash value growth. But then we can do the reduced paid up at year 8, which basically makes the policy paid off earlier than in this case. And so it reduces the fees on that. But even though it's a 10-year design, you could just fund it for 5 years and have the policy still perform actually pretty nicely. And then for number 2, it's basically the $50,000 design, but it's a 16-year funding duration. So this one, I'll look at it as a bucket size of 800,000. Pretty similar year 1 liquidity, but because there's a little bit higher death benefit needed to support that, there's a little bit more fees. So you see a slight drop in liquidity, but you'll notice that the MEC limit is $102,000. So it's a higher amount. I'm still breaking even now at year 5. But what happens if you do the 2A and front load it, you also see, because it's a higher death benefit, the paid up additions rider schedule is slightly higher than the number 1 one. If you recall, the total about $5,089. Now this one is 53,000, almost 5,300, almost 5,400. But the MEC limit was actually 113,000. So this shows dumping in 113,000. And what happens, and you'll see the liquidity jump up even higher, so 93%. So that's actually pretty good. What you have available is 95% of these cash values because they're reserving the loan interest ahead of time. What you actually have is 95% of this, but still 93% liquidity, which is very good, pulls up the break-even point to year 4 in this case. And then similarly, 2B, I show what happens if you were to just, even though it's a 16-year funding duration, what happens if you just fund it for 5 years? So the same things, we're cutting it off, and it allows major flexibility and not having someone feel like they have to commit to the 16 years. The second one also it's all the exact same designs, but it's just that instead of receiving the dividend, which is the 5.75, it's actually receiving that 6.5% average index return. For Guardian, there's no fee to have that feature on, but if you utilize it, so in this case, in these illustrations, I show utilizing it 100%. That kicks in year 3. So the first 3 years, you're actually just receiving the normal dividend. Then from year 4 on, you start receiving the index return. So the numbers will look identical from the index to the dividend in the first couple of years. It'll change from year 4 on because it's receiving the dividend, but it's receiving that 6.5% index return. There's a 2% fee to utilize that feature. So I would look at it as it's actually you're receiving a 4.5% return, that's why you'll actually see, even though I'm illustrating this at 6.5% index return, the numbers are less than the dividend return. But I wanted to just show that. So that's the second tab. It's all the same things, 50,000 for 10 years, front loading, cutting it off at 10 years or 5 years, and then the 16,000 design, cutting it off for 5 years and front loading. But take a look. I know these are long illustrations, but I wanted to get this out so that you can start playing around, and we'll touch bases and we can definitely brainstorm and collaborate.
The video I created for someone just looking at different designs, wanting to understand how the funding duration can affect the different flexibilities. And then as you can see, we can play around with some of the numbers so that essentially, say someone had a large lump sum of cash lying around, wants to basically front load a policy, or what we call dumping in or front loading a policy. That last design, or number 2, it allows someone to dump in 113,000, but really only have a $50,000 design policy. So the fees are, basically under half of what a $100,000 design would be, but still meet their requirement of dumping in that 100,000. And then that specific person wanted more of a $50,000 design going forward, because that kind of matched his cash flow and his goals. So that just helped highlight some of the flexibility there. Secondly, he was interested because he was trying to compare IUL. So he wanted to just see that index participation feature, which Guardian has. And again, that's instead of receiving a dividend, you'll receive a return based on the S&P 500 index. That's why there was that second tab. But that's very typical to maybe some of our follow-on calls, that we listen to what people's goals are, provide various illustrations, and then maybe some back and forth as far as tweaking it and just showing all the different possibilities, so that 1, the client gets a better understanding, and then 2, we end up with a design that's more ideal for them. Again, we don't want to oversize it because there's fees associated with that, but then also we don't want to undersize it and then them ending up with too small of a policy that they wish that they had something larger.
And I'll be honest with people, this is why a guy like Tyler needs to specialize it all the time. This is not my area of expertise, and this is where I rely on a guy like Tyler to know what I'm looking for and putting me in the best position possible. As far as some tips from my side is understanding what the break-even point is. This is not only going to help you understand when these policies start to make sense. Typically, it will be like under that 5-year period where your cash value is worth more than what you put in. But this is also a very key thing to comparing other people's policies, because some agents out there will fatten up the commissions on their sides. If you got the same policy configured in the same way, this really helps to distill all that stuff out, so you can truly get like the best price for what you're getting. But for the most part, when you're going with the big carriers, these are pretty much commodities. A lot of our investors are engineers, and they get a table like this and they really want to try and understand it. I would probably urge those people to not do that, because what's likely to happen is you're not going to do this and you're going to miss out on this whole double dipping effect that we're talking about. You're going to try to over optimize. And when you try to do that, typically what happens is inaction. Again, I would just say for starters, just start at the break even point and move from there and trying to take the stuff with a grain of salt. But there is obviously a lot of technical things on this, and that's where I my full faith and dive into kind of understanding which levers to pull for the right people.
I do want to add, like, those designs, those are actually pretty standard designs. There's a little bit more things we can do to tweak it to boost up some of the things. But those 10-year, 16-year designs or 5-year designs, those are pretty typical. What Lane mentioned, that accredited investor banking design, that's a little bit more complex design intended for someone with a lot of cash available that they want to get into a policy quickly. The one downfall with a lot of designs is that it's more intended to spread the contributions over at least a few years because of the limits and the ratios of the death benefit to how much you can contribute. So a lot of times, counterintuitively, it doesn't make sense that you would rather someone always comes in and say, hey, I want to just dump on $1 million on the policy. Actually, spreading that $1 million over 2 or 3 years is a lot more beneficial as far as the size of the policy and doing that, which is really counterintuitive. But there may be some tweaks that we can do. Again, that's why there's no real cookie cutter design. There's basic starting points, and then we can go from there.
Yeah, and we talked about Chris, the credit investor banking thing, which is new. Essentially what it is, like, for investors who have a big chunk of liquidity, maybe $250,000, $500,000 or more, that you really want to get working, that accredited investor banking setup where you flash fund your policy with this big tranche the first year or few is the way to do it. But if for most investors, they don't have $500,000, $250,000 lying around not doing anything. So that's where the traditional infinite banking setup, where the way we structure it, normally it'll be a 7-year pay program where my first policy, what I did was $50,000 per year. So I think 15 grand of that was the premiums. The rest was the paid up additions. So that was my pay program there. I think my first policy, Tyler didn't do my first policy, so my break-even point was 7. Kind of sucked, but it is what it is. Then Tyler did my other policy, so it was way better. That's typically, you'll see when we just start, just for conversation's sake, or when you're talking to other investors, I would say you're doing a policy for 7 years and you have a certain commitment level, $50,000, $100,000 is typically the normals for people in our group. But again, if you have $250,000, $500,000 lying around, and you just don't want to mess around and you just want to throw it in there, which makes sense. If you could put in 100 grand here, and if you have maybe $300,000, $400,000 sitting outside doing anything, don't you want to get it working so you can get it flowing into a deal? And that's where accredited investor banking comes into play, that flash funding type of mindset, as opposed to the steady pay program. Different situations for everybody, of course, but that's essentially the idea behind it. I guess, Tyler, like, while we're at this, is a pretty standard table that in most they call these illustrations. Maybe tell us a little bit, like, how do they find the break-even point? And then we had a couple of questions down here. What is the max we could take a loan from, and is it from net cash value?
The net cash value column is the focal point. That's your cash value. As far as calculating the break even, if you look over cumulative net outlay, I think that's 5 columns on the left. You'll see, like, at year 6, 300,000 net cumulative outlay with a cash value of $308,000. So that I would consider the break even point when you're comparing net cash value is equal or greater than what your net outlay was. That's what we consider. It's almost at year 5 in this case, but yeah, I would call it year 6. Keep in mind that and this is specifically a Guardian illustration, but Guardian's illustration, that net cash value is at the end of that policy year. So that'll include the dividends which you receive right before your next anniversary. Those numbers are the end of the policy year. What you have available is, conservatively, I say 95% of that net cash value number And the reason why I say 95% is because when you request a loan, they'll hold back the prepaid interest for that policy year. So say you're right after your anniversary, your next anniversary is a full year away, you take out $100,000 loan, they're going to reserve that, in this case, 4.762% of interest ahead of time. So that's why we say you have 95% of your net cash value. The other key thing you might see is if you look at that net death benefit, it's level for whatever your funding duration is. That net death benefit is purely there just to support how much you want to stuff in. So when we're designing a policy, the two variables we're usually working with is the target amount or how much you want to try and put in the policy every year, and then for how long. And then you multiply those two and you get what we call the bucket size. So say $1 million bucket size could be funded many different ways. You could do it $250,000 a year for 4 years. You could do $500,000 in 2 years. You could do $100,000 over 10 years. All of those designs would look slightly different, have slightly different requirements on that. You'll also see that in this case, after year 7 and year 8, the base policy annual premium, the $4,546, goes away, because what we're doing is we're doing a reduced paid up, and where essentially the policy becomes paid up, so the premiums are no longer due. Traditional whole life, you're paying those premiums for your whole life till essentially 99 in this case, or age 95, the specific product. But what we're doing is we're doing a reduced paid up, so it makes your policy paid up. The cash value continues to grow, and at that point you'll see the death benefit grow, because what's happening is you're still receiving dividends. Those dividends of the policy is being applied as paid up additions. Paid up additions basically is purchasing additional paid up whole life premium or insurance. So your death benefit along with your cash value continues to grow, even though you're no longer paying anything out of pocket for the policy.
Yeah. So after year 7, you're done making any policy payments to it. That's right here.
And then looking over at the right, the breakdown of that your target amount, in this case, it's a target amount of 50,000. That top number, the annual premium 4546, that's basically what we call the base premium. Our goal is to shrink that as much as possible, and then have that paid up additions rider unscheduled, or that 44,975 amount, the largest possible, so that you have the least amount of fees, which results in the most cash value.
And the key thing too with this annual premium being so low, let's just say you get a few years down the road and something happens and you lose your job, or you're like, wow, this wealth elevator stuff is working, I'm just going to quit. And you have less money to pay the premiums, but you aren't working anymore and you're now happier because you're not working. But life changed, right? So all you have to do is keep paying this much smaller portion for the years that you signed up with. But as you can see, this amount is pretty minimal. But when you have this done with traditional whole life, or even the infinite banking whole life with the 50-50 split, this number is a lot bigger. So unless you pay that amount, your policy somewhat caves in or cannibalizes itself. So that's an additional reason why you want that premium to be so small, other than just purely commission standpoint.
And as far as why we like Guardian so much, a lot of it is that flexibility with the PUAs, that ratio of limits. So that base premium 4546, if you multiply that by 10, so that's what the maximum PUAs you can get in that ratio. So that's a large ratio compared to maybe other companies that may only allow 5 times or 9 times. Accredited investor banking, you're able to go up to 50 times in year 1. So that's what we're really playing around with to be able to stuff in a lot. Secondly, not only the ratios, but that 44,000 of PUA unscheduled, the flexibility in that is totally optional and flexible. There may be a year where you don't have that whole amount. So say you only dumped in a total of 10,000 in year 3. You have the remaining 40,000 of unused PUAs. That will not just die and get lost, it'll actually roll over to year 4 in this case, where now you can make a catch-up payment. So you can, if you have the 50,000, you can do the 50,000, and then you have that extra 40,000 from the previous year, you can make that catch-up payment. And you're able to do that within your funding duration. So that allows a lot of flexibility. Again, you're impacting the earning by delaying dumping it in, but you're not losing the ability to dump that in the future years. Some companies may limit you to a 3-year window, or take the average of how much you've dumped in over a certain amount of time, and that's now your maximum. But with Guardian, you're able to catch up any amount as long as it's within your designed funding duration. So that's why sometimes people may not want to fund, say, 15, 20 years, but having it designed that way, you have the capability of and flexibility of catching up all the way through those 15 years. And then you can short fund it and do the reduced paid up earlier. So it just adds a lot of flexibility. And that we would have to go through like personalized designs to show specific examples.
Again, these policies are not really made for the death benefit. To me, that's what term life insurance is for. But Tyler, say a guy, he makes all his payments, say he's supposed to, year 3, he unfortunately passes away, and then the insurance is triggered. But say he invested, he took out a cash value loan of 100 grand. Maybe talk to us a little bit the math behind, like how much does his family get paid at the end of the day?
Yeah, so that net death benefit, 985,000, would basically be reduced by your outstanding loan, in this case, 100,000. So then the beneficiaries would get the 885,000. A lot of questions we get is, what's the rate of the policy loans? Throughout a lot of the companies, it varies between 4.5% to 6%. The companies we specifically use, and I'll just stay with Guardian because that 95% of the investors and of our clients like Guardian, myself included. Fixed rate is advertised at 5%. What you truly feel is 4.762%. That's a fixed rate for the first 10 years. After that 10th year, you have a one-time option to choose to make it go variable or not. I personally intend to just keep it fixed because for stability purposes and planning. If it's variable, it'll get tied usually to the Moody, the AAA corporate bond index rate. And then companies would be declaring that variable rate in the beginning of the year or at the very end of the calendar year for the next year. And usually there's stipulations in there, especially with Guardian's one, that it can't go up by more than 0.5% year to year. So even though if there's a huge spike up, the variable rate won't jump up in that sense. It doesn't have any limit going down. There's usually a floor rate or a minimum rate. In this case, it would be a minimum of 3% for that variable rate. So even though interest rates go back, that floor will still remain at 3%. And then, yeah, as far as repayment plan, you don't have any monthly statement. It's totally up to you. You are in control and you can pay it back, pay the interest only, pay interest and principal, or nothing at all. There may be different stages in the policy life where either one of those makes sense. And we can help illustrate and show what that may look like.
A question that came up more from the taxes side on this is, can I deduct the taxes, the interest paid on this loan? So you're going to be paying interest on this, and that depends on how smart you are as an investor, right? Like to me, I would call this a business expense to make money. Now, you obviously have to tie that to a means of making money, which should be if you're in investing. If you take this policy loan and you go to Disneyland with it, you probably aren't able to write that off. So I think it's very important to kind of show the dotted line to what you're using it, and obviously work with your CPA. But I think a lot of you guys are sophisticated where you guys automatically do this. For the most part, most of you guys are accredited investors investing. You guys are taking the loans to go and invest, and therefore very legitimate, I think, a business expense that should be able to deduct that pretty easily.
Yeah, one thing I do want to highlight also is that some people automatically feel like you have positive arbitrage. So I mentioned the gross dividend rate of Guardian is currently 5.75%. I want to emphasize it's gross because what's hidden in there is you need to subtract out company expenses, mortality costs, all of these insurance costs, it's hidden in there. So I like to conservatively think you're going to subtract 1.5% from that. So what you really see as far as growth is maybe 4.25 right now with a 5.75% gross dividend rate. And then you're paying an interest rate of 4.762%. So oftentimes people automatically like, this won't work because it's a negative arbitrage, right? You're earning 4.25, paying 4.762%. But you got to keep in mind that policy loan interest rate is simple while your earning rate is compounding. And mathematically, even though it's a negative arbitrage over time, and again, we want to emphasize that this strategy is a long-term strategy, but over time, that compounding effect will catch up and surpass that simple loan interest, even though the rate itself is higher.
We're not going to go too much into this strategy. There's a lot of banks that will give loans on your cash value policies, again, because of the security nature of it. So what a lot of people were doing last year, where they were going to a couple of these banks and getting a little bit better loan interest rate than what they were getting from if you're going direct to Guardian. It was a little bit more headache, in my opinion, but hey, if you have a large policy, then you're able to save maybe thousands of dollars doing it this way. But we have this in the archives of the Infinite Banking eCourse, and I think this is what's important. It just highlights the need to get around other sophisticated investors. At some point, this strategy will again come into play, and this is just illustrating what are some of the more advanced things people are doing with these types of setups.
Yeah, we got a question about what companies are all the companies the same. We specifically like to use a large mutual insurance company. So the difference between the mutual insurance company and a stock company. So stock company would be something like Prudential, where there are stockholders. A lot of times with a stock insurance company, the focus is appeasing stockholders. Or mutual insurance companies, there's no stockholders. The owners of the company are the policy holders. The true focus is on the well-being of the company, which then benefits the policy holders. And then secondly, participating mutual insurance companies that share the profits in the form of dividends, and they distribute that out to policy holders. We mainly use MassMutual and Guardian. Other strong insurance companies may be Northwestern and New York Life, and then Penn as an up-and-comer, but we heavily utilize mutual insurance companies. And then as far as the size of the company, because this is a long-term strategy, we want the stability. We do look for a company that has been around for a long time. Guardian has been here for 163 years now, and they have a strong track record of dividend paying along with paying out the death benefit. So being solvent to pay that. Some of the small insurance companies may look a lot more attractive because they may offer maybe a little bit better terms, but they may not be as solvent. Some of those companies do just get bought out by larger insurance companies because they're not able to sustain their payouts. But we choose Guardian MassMutual, which has been around for a while. And again, if you look at the actual performance amongst like all the top insurance companies, the insurance product itself, there's not going to be much difference in the long run over the years. It's the small differences, whether it's a good online portal, the PUA flexibility, if they encourage loans and support taking out loans early on and frequently, like those are probably the bigger factors when you're talking about which actual insurance company to use after you've gone with either one of the big four.
I think the big thing is just don't work with the smaller, more rogue companies out there, like the ones that haven't been around. I know people always are like, what do you think of this insurance company or that one? And it's always, yeah, maybe it seems like a little bit better rate. But again, if there's one thing we kind of stress is we just don't want to take a chance on something like this. And let's take the risks and get the reward on the investment side. But for the infinite banking accredited investor policies like this, let's not take chances here because there's just really not much to gain.
Am I too old to start or implement this strategy? We have some clients in their late 60s and this works. The biggest difference you'll see is basically the amount of death benefit associated with that same dollar amount putting in. So if you're comparing like a 20-year-old and a 60-year-old illustration, someone dumping in 50,000, that 20-year-old might have to have like close to $2 million of death benefit or so, or maybe $1.5 million of death benefit to support that. Whereas for a 60-year-old, you're only getting maybe $700,000 or $800,000 of death benefit for that same amount of premium. Again, we're not doing it for that way. And then when you're looking at the cash value performance, the cash value performance actually looks pretty similar because the fees are shrunken. The cost of insurance is really not a huge factor as far as the PUA portion. But what you'll see is because this is a compounding effect, and when things compound on the later years, that's where the exponential growth really happens. When you're talking about a 20-year-old, they have on average 65 years of projected life of compounding, whereas a 60-year-old may only have 25 years. So those additional 40 years of compounding on the back end really starts making the policy look very attractive versus just that initial 25 years. There's some small growth. It didn't have time to really compound and reach that exponential growth. And another question we get always is about children. It can work. People often think, hey, the cost of insurance for a child would be much smaller. But because we're really utilizing this to stuff as much funds in as possible, oftentimes with a child, the amount you can stuff in is very small. If you're purely looking at it for IBC, it usually doesn't make sense, but there may be other benefits as far as locking in a child's insurability or having a teaching product or some actual policy for them to start learning some of these strategies with. But purely financially, it may not be the most efficient use of those dollars on a child's policy versus, say, a working adult.
Yeah, we have clients doing this as 50s, 60s. But once you start to get to that age, then the kids of those people are typically getting to the working ages. And then that's when it starts to make sense in terms of kids, because they make money. And that's essentially what the policy is based off, what the earning potential is.
Yeah, and the strategy utilizes insurance. There is a generic cap on how much insurance one can buy. That's really mainly dependent on their earning power. The traditional use of insurance is to protect one's human life value. That human life value is basically just a factor of your earning power for the rest of your life. For example, a 20-year-old, you'd multiply that annual gross income by 35, and that dollar amount is typically the limiting factor as far as death benefit one can pull on themselves. When you're 30 to 40, that will be limited to a 30% factor. Above 40 drops down to 20. In your 60s, it might be a factor of 10 only. That's where although the cash value growth is the same for, say, a 30 or 40 or 60-year-old, sometimes it's the amount of insurance you can qualify for is a limiting factor. We like to limit the death benefit to below 10 million. It makes the underwriting process a lot easier as far as having the documentation for that stated income. Below 10 mil, it's really self-certified by the agent and the client. Above 10 mil, it takes into third-party certified docs, maybe a little bit more scrutiny in that. Usually a 10 mil death benefit policy is sufficient for everyone's goals as far as how much they want to stuff into the policy. But that's where, again, these are just generic rules. And then as far as limitations, also generally it's the health. It's not saying that someone with underlying health conditions can qualify. It may affect the health rating. Fortunately, the health rating and will affect the premiums. And because the premiums we're trying to minimize, it doesn't have as large of an effect as what people think. But when you're looking at, in the long run, say 30 or 40 years out, it could look a couple $100,000 maybe difference in cash value when you're looking at a large policy with the health rating. So that's where a lot of times someone within maybe either your family or a business partner, it may make sense to maybe have the insured someone else other than the owner if the owner may have some pre-existing health issues.
So I had a question. This kind of partially goes hand in hand with the last slide. And these questions are, if I had the liquidity, why would I cap this whole strategy? Why wouldn't I max this year after year, increase the policy size, borrow, invest, repeat? What is the downside to making this as large as possible? This is getting more into the holistic strategy, right? This goes beyond just the infinite banking accredited investor policy. This is more like portfolio theory. It all depends on where you are in the wealth elevator, right? This is more of a question being asked by a gentleman who's beyond 5 million, maybe even above $10 million net worth, which if you guys take a look at the wealth elevator book when it comes out, there's a little chart depicting on where everybody's at. But as far as Tyler said, when you get above a $10 million policy, which is typically going to be like a $3 to $5 million liquidity in the first year, which you're going to need to have that net worth plus, right? Because it's not going to be all in your infinite banking policy. So you're talking a net worth of $5 to $10 million person. So when you get above that $10 million, it becomes a little cumbersome to qualify for that. And that was something personally I went through with Tyler, helped me through it. And it's not that it can't be done. It's just like, why, right? As Tyler mentioned earlier, for most people on the call today, having $1 or $2 million of a liquidity source in these policies is going to be good enough. And a $5 million or $8 million policy will probably get you there, might even be overkill. So to take this strategy to the extreme, it just gets to a point where like, why do you need to have this big policy? And that's where I would say there's other things beyond here that I think are better. The downside is that they don't have as good a liquidity as this. So to me, in my opinion, and again, this is all personal, is if you've got a nice liquidity of source of $1 to $2 million, which this provides in case anything happened, heavens, you need $3 million. I don't know what you need that for, but you wouldn't need that liquidity as quickly as you can get it within the week in these types of policies. And therefore, there's probably a different mechanism. Maybe you start to diversify it too. Maybe you have real estate or other holdings, but it just is more of this idea of you start to put your wealth into different pockets. But if anybody is under $5 million net worth, I wouldn't really worry about it, but this is to try and answer the questions from everybody. And we have a wide range of investors here. That's the mentality of why you wouldn't just take this thing to infinity. We're starting to build the curriculum for this in the Wealth Elevator, and some of the members in the family office, after they've fattened up their infinite banking policies to a certain extent, to then have their stock holdings and to utilize security-backed line of credits in a very advanced way. But I would say, again, if you're above $5 million net worth, you probably should be in the family office group talking to those types of people directly. And then the second question here is, I understand that we should pay the interest. Is there any rationale to ever paying back the principal? Does anyone ever do that as an investor? It doesn't seem like you would ever want to have this fully funded. Exactly. And maybe it depends on where you're at. And Tyler may have a different answer than I, but to me, when you're in your growth years, you're trying to grow your money, you're going to probably suck all the cash liquidity out of your policy and have it invest in some other venture where you're going to make more than double digits, a lot more than you're going to make within this policy. But once you hit that critical mass number, again, $2 to $5 million net worth, that's when you start to pay back the policy and store the liquidity there and start to build your cash value in the policy. Essentially, if you're somebody under $5 million net worth, you're in this process of growing your net worth. You're in this process of growing. So today you're starting these policies and building the containers. You're going to take the money out of the containers and put it elsewhere. But the important thing is you establish the containers today so that 10 years, 15 years down the road, you have the containers that you built today to store the liquidity. And then as you can see, everybody's on a different time horizon, but that's essentially my thought process of how does this fit in the big picture. Yeah, it's very similar to a guy's got 10 rental properties. He uses good debt. He doesn't pay them off right away, but at some point they pays it off. Of course, that's all flawed because you don't want rental properties because it's high liability. You got tenants, toilets, termites, houses break, where this is a lot cleaner, of course. But for the same ideas, right? You want to use good debt and leverage, especially in the growth years. But I don't know, Tyler's any other thoughts or viewpoints on that?
Oh, yeah. It matters where you are in your journey. What I see from clients, most people, they don't take out everything because they're leaving some other reserves anyway in their policy. Policy is where a lot of people hold their basic reserves. But for myself included in this growth phase, yeah, all of my available cash value is out working for me. At some point, this is potentially like my plan B retirement supplemental income source for later, not having to find additional deals or do other investments, just park all the capital back onto the policy, be happy with that 4% or so annual return and live off of that and be stress-free, not having to worry about the health of any other investments. I'm not sure if I would actually do that, but it's just nice to have as a potential plan B.
Well said. But this is hard, right? We don't know what people are doing in their individual portfolios, and everybody's on the spectrum. I would certainly say for somebody who's under $2 million net worth, if you've got 20, 30 grand in your checking account and you're keeping 50 grand in your infinite banking policy at all times as cash value, I don't know. I think that you need to get that 50 grand working elsewhere because you've got to grow your net worth. But if you're 5 million, $4 million net worth, and you've got your 30 grand in your checking account and you want to keep couple $100,000 in this as cash value just in case, then I'm not going to give you any qualms for that, right? You're getting to that part of the spectrum where you can be a little lazy with your liquidity here and there.
As far as taxes, I would say any contribution you make, you can withdraw from the policy, penalty or tax-free. So it's after tax dollars going into the policy, you can withdraw your contribution. Most of the portals now will keep track of that, how much your tax basis is, and you'll be able to know how much you could withdraw. Again, would highly recommend not withdrawing. There may be a time in the policy where withdrawal makes sense, but typically in the growth years and the beginning of years, we do not like to withdraw those funds. The earnings within the policy technically grow tax deferred, because if you again were to withdraw those gains above your contribution or above your cost basis, that'll be taxed as ordinary income, right? And so it's really tax deferred. It's tax free because upon death, the growth of the entire policy or whatever that death benefit is in the policy, which includes all of the growth, transfers tax free. It could potentially fall under the estate. So I would work with an estate planner to see how you could implement different strategies to maybe minimize that. And then if you could cash out the loan, or you could just basically surrender the whole loan. Again, if the cash value of the loan that you're surrendering is more than what you've put in, that'll get taxed. And again, if you lapse on a loan, the loan itself wouldn't technically lapse. It'll basically just eat into the policy where it just dies. But basically the main taxable points is if you cash out, surrender a policy that has growth in it, or you withdraw funds. Other than that, it's technically tax-free.
And of course, we're not CPAs, tax attorneys. Get you with your own CPAs. And if you guys need a good one, let us know. We can connect you. Just send us an email. Here are some of the add-ons. Again, like this goes beyond just the regular infinite banking, accredited investor banking, where you're double dipping, you're growing that policy, using it as a tool to invest elsewhere. But these, again, it is insurance. So you've got these types of riders that you can add on to the policy.
Yeah, and I really like that accelerated death benefit rider. It basically allows you early access to the death benefit portion in the event you develop a chronic illness or a terminal illness. So instead of having to wait to utilize that death benefit, which is often higher than that cash value. So you always have access to the cash value, but the additional part of the death benefit allows you to access to it. There's some limits on how much you can get annually and cumulatively, but it is a feature there. It's free. There's no expense, and this is basically a side benefit of utilizing whole life for this strategy. And there are other additional riders. All the other riders do have a fee to it. I personally don't encourage putting on any of these riders because you would probably want to just have, say, like a long-term care rider separate and have that purely a long-term care. Adding it on to the whole life and this infinite banking strategy is not the most efficient use of that fee. So there's better options dedicated just for long-term care. That guarantee insurability rider, again, because we're often talking about larger policies, that fee is not really worth it. It just basically allows you to purchase additional $250,000 of death benefit every couple of years. Not necessarily why we're doing the strategy. And then similarly with that waiver of premium, in the event something happens to you, your premiums are waived. Our design, that premium, so saying that $50,000 design, it's just that $44,546 portion, not the POA portion. So you're paying a lot for a small portion to be waived, and again, not necessarily why we're doing it. So oftentimes that cost is not warranted, and because of the flexibility and how we're designing it, in the event you can't make that premium payment, oftentimes the cash value growth is enough to cover that premium because it's such a small portion of the overall policy.
So it's like you're buying a car, and then these are the additives that go on there, and that's where I would just have a conversation with Tyler, which ones make sense for you, and he has a good feelings on which ones are making the life insurance company a little bit more money than they need to.
Underwriting process usually takes about 2 to 6 weeks. The biggest variable with that normally is obtaining your medical records from your provider. Some providers are very good, some take forever, but technically it's looking at, they're evaluating you and your risk profile. They're able to pull prescriptions, your driver's records, generic background check, and then there's a medical questionnaire that you answer, and then they review the medical records. Depending on policy size, you may need to do a medical exam. Usually that includes height, weight verification, blood, urine samples based on size or age, but that's usually it. There's no cost. This is all covered by the insurance company. And some feel that it is tedious, but it's really protecting you as a policyholder and the company as its whole. They don't want to let people in that are basically going to get a payout and death benefit and impact the company. If you see early on a policy, the death benefit return is huge compared to what you've put in, and doing a stringent underwriting process protects us as policyholders, protects the company, and I think it's a win. Also, starting the underwriting process or going through the application process doesn't obligate you to anything, right? That just starts the underwriting, qualifies you on a certain health rating, and then at that point, based on the outcome and final illustrations, you'll have a final decision whether this still makes sense based on what you've been approved, or maybe go a different direction.
If you take a look at this stuff and you see it for what it is, it's a double dipping effect, and you're being very efficient with the equity and capital you have to grow your net worth. It makes a lot of sense, but normally people drag their feet with this type of stuff and their trust documents, because it just brings into you dying, right, and putting it on paper. And I would just urge people, like, hey, just get it done. Like, I think once you get it all inked, then especially once you've had your physical, it just moves downhill process from there. But it's going to feel really good once you do your initial funding for it. And then to know that, hey, if something were to happen, you get that death payout to kick in. It just has a really nice feeling. And it goes alongside with the trust documents too. I think shouldn't cost more than like a few $1,000s to get a good lawyer. If you guys need like a cookie cutter one from our folks, let us know. But just to get your ducks in a row, it's on the similar lines there. But just to put this all in perspective, investing in good alternative investments to get a lot of the tax strategies implemented, because a lot of the passive losses, depreciation come from those alternative investments. And then having the infinite banking portion of it too. This is that 1, 2, 3 trifecta. Now, to me, make no mistake, I do think that the tax strategies for some and for others, the investing alternatives is the biggest one too of this. Infinite banking, especially if you're confused by it all, it is a smaller factor of the bigger picture. So for some people, they really geek out on this stuff and they don't implement the tax strategies, and maybe they could save 50, 100 grand in taxes this year alone, or invest in that opportunity. I would try to put it in perspective. As far as the just infinite banking in a nutshell, it's like the potential triple dip factor, right? Like you're investing in a syndication deal or a rental property or in any type of investment, and then maybe you're able to utilize that security-backed line of credit, which is a little bit more of an advanced technique that some folks in our firm are utilizing, and in addition to the cash value line of credit, which is the infinite banking policy in a nutshell. But to use these three in combo is what we've coined the term as the triple dip, and leveraging these lines of credit in this fashion. I just wanted to go over 4 use cases that I've seen be really successful utilizing infinite banking. So here, upper left-hand corner, typical investor will fund their 6-7 year policy with $100,000, $250,000 a year. They'll capitalize on the arbitrage between the rates. That's very small, but I think in the long term, especially once you pass that break-even point, you're going to start to really see those benefits, and you're really going to be thankful that today you made the move to get that all set up. Deal flow is slow these days, like just where commercial real estate is. So it might be a great time to get this set up now, and maybe do the tax pile fund to get it all moving, to prime the pump in a way. You can also kind of combo this with your PEP fund, can also combo with college savings for kids as you near the college age where your kids might need the funds. Or if your kids are a decade plus like me, you really get after it and get it moving. And some people will actually use this as a 529 plan killer. The 529 plans, the bad thing about it is you're stuck in investing in what's available, right? Within that cafeteria of options, where if you're able to use the infinite banking to go and invest wherever you want, and then also make money when the money's idle as a cash value, then it's the best of both worlds. And especially when you start to get to that point when your kids are in intermediate, late high school, you're going to not really want to be deploying the money right away. So it can be a great slush fund to store that money. Or if you don't have kids, you can just be a very short-term slush fund for you to just keep your short-term liquidity, or when you're saving up for that $50,000, $100,000 private placement to go into. Bottom left, the end game investor. These are the investors that have $4 or $5 million plus net worth, and they just want to simplify their life. And maybe they don't want to go into any types of real estate or venture deals, and they just want to simply put their money in probably one of the most safest types of investments out there and just have it purely grow in insurance. If you had $2 million in a policy at 5%, there's $100,000 per year of income to live off of. And I think what's a little bit different with these policies than people are used to, when you take a loan from your policy, you don't necessarily need to pay back the loan. Nobody's going to send you a coupon book to make payments back. I know some HELOCs are like that. Some HELOCs act very similarly to the infinite banking payback plan, where nobody's asking you to make payments. And that's in a way of, if you're somebody who gets really worried about like debt and making monthly payments or quarterly payments or annual payments, in these types of policy, it's a great arrangement because nobody's going to beating down your door to collect month after month. It just works its way through the policy. And then like a newer investor here in the bottom, some people take a while to get going. We try not to push investors, especially people who are new to the alternative investing world. This can be a great strategy to start to implement some of the strategies that we do within the Wealth Elevator universe. Some investors will have access to home equity via HELOC, and again, feel uneasy about those monthly occurring interest payments. In a way, it operates as the same thing, except nobody is bugging you to pay back the policy. I personally have, I don't even know how much. Maybe I owe myself $400,000 or $500,000 in one of my policies, but I don't intend to pay it off in the next few years. I'm just going to let it roll. And that's just, I think, a very common practice for people utilizing their infinite banking policies, accredited investor policies. Another use case is your friends or family who doesn't want to get into alternative investing or rental properties. They just want something super secure, or your older parents who don't understand rental properties or private equity. They just want something very secure with a almost guarantee rate of return. That's where this infinite banking policy comes into play. I would also say is in terms of like asset protection, proofing yourself from lawsuits by having a big chunk of money into your infinite banking policy is a great deterrent to creditors and litigators. It's not as secure as having an offshore account irrevocable trust set up, but for people under $5 million net worth, they probably can't afford that to begin with. So this becomes a great alternative to that. I would probably say it has a lot better protection than an LLC does. Of course, talk to your own asset protection attorney. But if you have 50 grand in your checking account and $500,000 in equity in your house and $500,000 in your infinite banking policy, you really need to worry about the 50 grand in your checking account and the equity in your house, because that is where creditors and litigators are going to go to first. And for the most part, your infinite banking is pretty much off the table in terms of getting sued with that stuff. And we gave a little bit of primer with Tyler's setup plan. If you guys need another starting point, my prescription for people getting started, assuming you've got a net worth of $1 million and you net 60 to 80,000 a year, which is what you save. So a lot of you guys, you may make $350,000 as a family, spend, what would that be, like $200 or so thousand a year. So it's the delta between, that's the net that I'm talking about. Most people within our community save $50,000 to $100,000 plus per year every single year, and that's what they do to investments. But we're saying, I would say start off with like maybe a third or half of that per year and use it as a starting point, a bare minimum to put to your 5 to 7 year load commitment per year. So that what that mean is maybe you take $30,000 or $50,000 a year and put to one of these types of policies. You add on to that based on, say, same situation, but you have $500,000 of home equity just lying around because you were tricked into paying down your mortgage, right? Which we talk about a lot. So in that case, what I may say is try to break up this $500,000 in 5 years. So that's where this 100 comes from, and add that on top of your base of 30 per year. So now at least $130,000, or heck, even take it up to $250 per year would be where this starts. But again, most people start off with way, way too little. I started with a policy where I did $50,000 a year, and I quickly outgrew that, especially when you start to invest, right? And you start to get involved in these alternative investments and you start to save. Some people in our family office group are able to save $50,000, $100,000 a year easily in taxes. And that's where they get that money, and they put it to things like this. By doing a 90-10 policy to minimize these fees and max load, a cash value policy really helps playing this a lot more aggressively in that fashion. And then another strategy too, maybe 2 to 4 years from now, you didn't listen to us and you got a little itty bitty $30,000, $50,000 policy per year. 2 to 4 years, you could get an add-on policy on top of that. So you layer them on top of each other. But the risk there is, what if you get diabetes or you pick up a smoking habit and it costs a little bit more, right? That's a risk on your side. And that's why I say just get the damn thing done now. Because it's a 90-10 policy, it's very low chance, and Tyler can talk to your own personal situations, that go ahead and buy the bigger container size. You're going to need it eventually anyway. And your health rating and everything is just going to get worse and worse into the future. And yeah, again, don't wait and overanalyze this stuff and wait 8 to 12 months waiting around, not doing anything. Because at the end of the day, your money is more safe in types of arrangements than deals and banks. You want to go through this. There's a video, I think in the eCourse too, but here's the URL on that. And then if you guys haven't joined the group, go to thewealthelevator.com/club, and that will get you access to the banking eCourse where you can get this video and all. It goes in like a workbook format where you go through all the topics individually. Tyler, you want to take these rapid fire style?
We are independent, so I can write for multiple companies. The company 95% of the business goes to is Guardian. Second would be Mass Mutual. Just Guardian, again, purely because of the flexibility, strong long-term actual performance, and just being a strong mutual insurance company. As far as minimum amount for suggested, there is no minimum. A lot of those policies, you could do a very small policy. The one caveat with that is the enhanced accelerated benefits rider. That free rider is applied only if your whole life death benefit is over 100,000. So sometimes doing a very small policy, that may fall off, which again, that was just an added benefit anyway. So technically there's no minimum as far as policy design. Number 3, yes. So being older, not having children, as far as there's 3 main components to a policy. There's the owner, the insured, and then the beneficiary. So oftentimes the owner and the insured could be different people. So in this case, the owner, the insured just needs to have a insurable interest in relation to the owner. So as the owner of a policy, I cannot just get a stranger off the street and have them be insured. There has to be some sort of relationship of why their life provides value to me. So say a niece or nephew, if you don't have children, they could be designated as your caregiver or your caregiver in the future. And if something were to happen to them, that death benefit proceeds will be used to hire a caregiver. Situation like that, we've set that up for clients in the past. And then being that you would be the owner, you would be funding the policy. Your nephew or niece would just be the insured. You have all the maintain the loan benefits, have control over the policy. As far as starting a policy over the age of 70, at that point, over 70, most likely it doesn't make as much sense. Again, we would have to run specific numbers, but at that point, we would probably look at someone else as far as being the insured. As far as infinite banking purposes for 70, that the need for that may be different. There may be other products or a different design using life insurance that may make sense if you're just trying to preserve capital or store capital.
And we talked about that earlier. At some point, if your adult children are kicking at a good job, then that would be more ideal. And then what we see a lot, most people are in a relationship, so they've got a spouse, and women are typically better to insure. They're a little bit more cost effective. Most times the wife gets the policy on them, but you don't want to have it in a situation where you put all your eggs in one basket. So it doesn't make sense to insure and get 2 separate policies just to get some diversification.
Number 5, yeah, no deals in life insurance, different policy designs, they have trade-offs. Some of the downsides with a 10 or 90-10 design, especially with Guardian, the way we're designing it, the sweet spot as far as funding duration, there is usually about a cap of max funding. So that could be maximum 15 to 20 years as far as max funding, whereas other designs, you may be able to dump in that your target amount, say 30, 40, 50 years. Most of our clients, myself included, 15 to 20 years is enough of a time to really capitalize the policy. I don't really intend to max fund it at least beyond that, but that is one of the major trade-offs. The other trade-off is that because we're seeking early cash value, again, the way the dividends and the growth of the policy is treated, you are giving up some of the long-term growth. And that's because having early cash value means that the insurance company themselves can't go and invest it. They have to have it reserved so that you can access it. So because they're not able to invest it, then your long-term returns may be slightly off. But as an investor myself, I'd rather use that cash value, invest it myself versus rely purely on the insurance company and invest in it. And the last trade-off would be that some of these designs, they use a lot of your human life value up, or it requires maybe a slightly higher death benefit in order to be able to have that ratio. Say like $100,000 earner, you may want to have a larger policy, but your human life value calculation has been used up by, say, that first smaller policy because it uses a higher amount of death benefit up when we're at. So that's the downside. Number 6, once a policy is paid up, we're not able to sink a large amount into it. Yeah, the upside is that no more premiums are due, so the expenses are reduced. The downside is that you can no longer also contribute PUAs. When we do a reduced paid up, at that point, we would want to fully be confident that you're no longer going to fund it. A lot of our designs nowadays, ideally, we want to make it as long as possible, the design, but you're able to cut it off, say at year 5, year 7, year 10, but have that flexibility to fund it long term if you want. But say come year 5 and you don't want to fund it anymore, at that point, we can do the reduced paid up. You no longer have to put in, but we can't turn it back on, say like at year 8 or so, and start it back up. It's paid up and it's done. Would it be better to do 2 policies and keep one going rather than having it totally paid up after 7 years?
I think it's more like the total, right? You can have 2 very small policies and the answer would be very different than if you had a $50,000 one for 7 years and a $200,000 one per year for 7 years. So it's more not really the number of the policies, I think it's the total mass.
Yeah, and as far as the first part, as far as better to have 2 policies, for me personally, because I'm also using it as a wealth transfer or legacy planning for our household, it's not only, I don't only have policies on myself, my wife also has policies, so at least spread it out that way so that both of us are covered. Again, the cash value wise performance, they would basically operate pretty much exactly the same. So say you had one $100,000 policy or 2 $50,000 policies, performance wise, they would pretty much perform the same. If you're talking like where the 2 policies are on similar people with health rating, age. Now, the administrative burden would be you do have 2 policies. So when we're requesting loans, you're requesting it from 2 different policies. They could end up back in the same checking account. So that could simplify things, but just keep in mind, yes, the 2 policies help to diversify the coverage, but then there you are dealing with 2 policies versus 1. Number 2, end game. I think it depends, right? Again, I think as Lane mentioned earlier, a lot of the benefit with this strategy is that it's a storage vehicle, but also liquid and safe. How much access of liquidity do you need? That's, I think, your personal question. And then there may be other vehicles for better storage, but less liquidity. I think a 10 mil liquid storage account for me personally would be sufficient. That may be too small for others or maybe way too large for others, but I think it depends on your personal usage. Number 3, I don't like charitable giving.
I think we put this in here because people use this as a base and then they go off and do all these other add-on additional strategies with their family foundation, nonprofit, and then as you alluded to, using as a teaching tool for your kids. But like some people will assign the interest of it to a charity at the end of the day, especially if they don't have kids. And they can also tie that in with what they call those trusts. I'm blanking on it, but basically you can get the tax benefit on today by giving it away today. I think this is more of like an advanced strategy, but we just wanted to bring it up to get the wheels turning for folks. Question, what do you think is a good target of how much % of one's net worth? There is no typical here, guys. If you guys are looking for an asset allocation mix of whether to do X multifamily, self-storage, or that stuff went out the window a long time ago. And this is where everybody needs to have at least 5 good friends that are accredited investors doing this type of stuff. If not, you need to find those people because these are the types of questions you're going to find for yourself. And again, this is how I picked this stuff up. I had no idea this stuff existed, even owning a dozen rental properties. Nothing is typical here. I don't know, like a guy that's $5 million net worth, Tyler, it would be nice to have $1 million or 2 of that in IBC, at least. I don't know. This what quick answer for that one is.
Yeah, for me personally, I feel I look at the flow of money while I'm for a certain amount of period, say for the next 10 years, and I want to get majority of that into the policy, and that's how we're designing it instead of percentage of my overall net worth. I'm just looking at how much can I capitalize it, what do I end up with, and that's what it is.
Yeah, I think this is where this stuff is fun for us, right? We have an investor meeting tomorrow night. I'm sure we'll talk about different usages of this, but for new people getting started with it, this is the start, is like funding this thing with a few $100,000, and then you get moving down the road and you start to pick up these different strategies, and then you start to see what aligns more with your long-term goals or what sounds cool to you after a certain point. But the first thing is get that sucker filled up with $250,000, and then you get creative. Number 2 here. But yeah, like Dave Ramsey really doesn't like Northwest Mutual. I've heard of it because I know why Northwest Mutual doesn't really work with these IBC policies, because they make it really hard for you to take the loans from it. There's not that, we call that liquidity. So they make it very difficult, and it shows through in kind of how the fees it's worked out. Do you know why Ramsey doesn't like the mutual company? He called out all mutual companies at one time.
Yeah, I don't know about Northwestern. Insurance-wise, they're a strong company. As far as flexibility, they're not as flexible. And also as far as an agent, you have to be like a career agent with Northwestern. Northwestern only allows career agents, so independent agents can't write for Northwestern. So it's a closed knit. They don't have as much access.
Number 3, what is the strategy for when to pay off the loans? So of course, I think everybody needs to grasp on this idea. Like when you're in your growth years, trying to build your net worth to several $1 million, the idea is to not pay off the loan. Again, the idea is it's a container that you're trying to create now. Now, at some point when you hit your end game, you hit your critical mass number, yeah, you could start to pay off the loans, but why? I guess I asked the question, and maybe I'll just leave it at that. It kind of run it. I don't want to put one strategy out there, because for end game type of people who get there to that promised land, everybody's a little bit different, and therefore their answer to these questions would differ. I would imagine you pay off the ones that have the higher interest rate, however insignificant that really is in the grand scheme of things. But just to give people another insight too, when you buy like houses, you can only get a loan for, I think, 700, 800,000 is the jumbo conventional loan, which means if you're buying a $1.5, $2 million house plus, you're going to have to put a boatload of a down payment, which totally like negates, it's just a deal killer in my opinion. And for people who really want to use good debt, use other people's money, using your infinite banking policy and maybe buying your house cash, but to put the debt on your infinite banking policy is just another one of these exotic strategies that I think about all day long, and a lot of people utilize in practice out there. I don't know, Tyler, what's your take on this one?
Yeah, I would say generically it's just the end game strategy, or simplistic thinking would be paying off the policy loan, you're saving, say with Guardian, 4.76%. I would just do the evaluation. Would that money be better spent saving 4.76, or do I want to put it out there and earn more than 4.76? And then the mindset of earning 4.76 may also come with some risk and headaches. So that's where, for me personally, at the end game strategy would be, even though I'm only saving 4.76%, it's more possibly the reduction of risk and headaches, and I'll pay off the loan and be happy with that, and be happy with that smaller gains.
Yeah. And also I think it comes into play where, say your kids are totally financially inept and they don't understand this whatsoever, then it would make sense to pay off all the loans, because you don't want to hand that over to them because they don't know what to do. Whereas ideally, you teach your kids how to invest money, understand risks, reward, Sharpe ratio, and they become good investors, and you don't pay off the loans and they keep it rolling. And sure, they may tweak the investment strategy a little bit in the long term, but you just gracefully hand off the keys to this policy with some open loans. So that I think that has a big part of it too, in terms of transition plan, succession plan. After your funding period is done and there are no more premiums, is it because the policy is paying the premium, or are they gone completely?
If we're talking after the funding period, so the design funding period, it would be because we've done the reduce paid up. So essentially it's gone because there's no more premiums. There may be a time where within your funding period, you're not paying your premiums. The premiums would still be potentially due, and it would be taking the cash value from the policy. So it's cannibalizing it a little bit, but at that point, there should be enough growth to cover the premium costs. So it doesn't have to be out of pocket, but you are impacting the future growth of your policy by doing that. Number two, we've touched basis on that about withdrawing the cash balance if needed. Yeah, you can withdraw up to your cost basis with no implications. Beyond that, it would be taxed as ordinary income or capital gains.
And I'll take number 3 here. A guy's trying to figure out the best way to pay off $30,000 of student debt by using a policy life loan. So again, this is starting at the top. We had talked about like the incorrect use or the suboptimal use of these types of policies. Let's just say your student debt is 7% or 8%. Yeah, it would make sense to pay it off on one hand because you're going to use the money here and it would probably be a less interest rate than that student debt. But then again, if that debt is long-term debt, why not just take that money and invest it in making something that's 12-20% a year, right? That's the thinking that needs to happen from the investor's perspective. And this is where you can use these types of policies basically as a tool to do either way. You're at control here. Her question was, do I have to pay taxes on the income I make from the money I borrow? So those, regardless whether you borrow the money from here or not, it's still income generated. It is income, whether it's passive or ordinary, that's up to you.
But I don't know if she's specifically asking, say she borrows the money from the policy, then goes and invests it outside the policy and makes a return on that. That money, that gain would have to be taxed, because when you borrow money, it just comes into your checking account. You can do whatever you want. That's not protected within the policy as far as the tax deferred or tax-free growth.
Yeah, I think maybe she's thinking that it's like a solo 401k or self-directed IRA. In those circumstances, that would be insulated in those entities. In this case, the policy is owned by you personally, typically, and it doesn't really have that insulating effect. I think we're maybe getting confused because Tyler and I use this verbiage of within this policy strategy, right? It's just a strategy, but it's not like a tax type of insulated vehicle, if that makes sense.
I think that was all the questions.
I think that was it. We went pretty long here today, but I think it's definitely warranted because people put serious amounts of money into it. But once you get this stuff and you interact with a few people who already do this, I think it makes it's not as confusing. That's for sure. In essence, it's pretty simple in the end of the day. It's just, we definitely wanted to cover most of it here for folks, especially if they were new. So a lot of this will be put into a constantly updated eCourse. You guys can get access to this at wealthelevator.com/banking. If you guys want to book a call with Tyler, you guys can reach out to him at bank@wealthelevator.com or shoot us an email at team@thewealthelevator.com. Here's the legal notice and disclaimer. We're not giving you any tax, legal advice, or financial advice. Everybody's situation is a little bit different. With that, if anybody's got any questions, we will close the meeting. Thank you all for coming, and we'll see you guys next time. Bye.